Well, hello, everyone, and welcome back to another episode of the Microfamily Millionaire. And this is our sub-series to the Share the Wealth show, where I bring you tips, strategies, what I'm doing, what's going on in the marketplace to help guide you for buying your first small apartment building. And today, I'm actually going to explain how you can build a portfolio that gives you your dream lifestyle, just full of options and freedom. But there's one caveat to that, and we'll get to that in a minute. So when you think of real estate investing, are you planning for cash flow or for appreciation? What's your strategy? Most people immediately think, I just need cash flow, right? To help pay these monthly bills and give me the lifestyle I want and all of that. That's great. But if you are starting with a limited amount of capital in your pool to invest, you buy this first building and then you have a great cash flowing asset. But what's your plan or strategy to scale if that's part of what you want to do? How are you going to buy the next building? So some people might also actually just look for turnkey because they don't want to do a lot of this stuff, right? You don't want to have to find the tenant. You don't want to have to do the rehab. You don't want to have to manage the property, all of those things. You want it to be as hands off as possible. So you find a turnkey, small multifamily property to purchase where everything is kind of set and go, right? It's all done for you. That's also a great strategy because some people don't have the capacity, time, lifestyle is too busy to be able to handle all the dues of being a real estate investor, because trust me, it's a lot. The issue with buying turnkey then is because somebody else put in the work for you. So you are paying a premium for a turnkey building, right? You have to pay them for the sweat equity that they put into finding a distressed property, rehabbing it, finding a good tenant, managing it, all the things, right? They did all the work, whoever you're buying it from, the turnkey operator. And so you get an easier entry point as far as like headaches, I guess. So just know you are paying a premium. So your cash flow is probably, it could be good for what you want to do, but it would be better if you could do some of that stuff yourself. This is a strategy that I'm going to talk to you about today. It is the polar opposite of turnkey, and it's called value add. Or you could also call it forced appreciation, whichever floats your boat. They're both doing the same thing. If you're adding value, you're forcing appreciation. So that is the concept for this strategy. So let's say if you're doing multifamily and it's a residential size, like a 2 to 4 unit, your value add strategy is going to be primarily based off of doing a rehab on the property, right? And getting the units up to comparable units in the area and that comparable rent, right? But it's going to also be for comparable sales of buildings like yours in the area if you're doing on the residential side. If you're doing on the commercial side, you can also, on top of looking at unit upgrades and small rehab, even if it's cosmetic, you can look at increasing the net operating income because that also affects the value for commercial buildings. So if the rents are below market, maybe it's an owner who never bothered to raise market rent because they didn't feel like doing that, right? They like their tenants, they just let the building run and hum along, and they don't need to increase rents. So they're like $200 or $300 below market rent. You could come in and just not have to do any rehab, just increase the rents. Or let's say they have a very high expense ratio. So their insurance is super high. I mean, that's across the country right now. Anyway, I don't know if you're going to get around that one, but let's say they have a service for landscaping or for trash removal or things like that. And those are like really high bids. You could find another vendor to come in who can give you a better quote at a lower price point, right? So if you decrease expenses or increase income, you're increasing the net operating income, and that increases the value for a commercial building. So like I said, residential, you could do physical cosmetic rehab. Commercial, you could do the physical cosmetic rehab, but you also could just affect the building's financial operations and improve those. So let's say you decide to go ahead and put in the work yourself and fix whatever the issues are, whether it's physical or operational or a small mix of both. So now you have a property that is worth more than when you bought it. So because it's worth more, let's say you bought it for 500,000 and now it's worth 800,000 or 900,000, right? Now you go and you take out the equity, you refinance, and normally they'll let you do 75 to 80% LTV on a bank, depending on your experience level, but just shop around. There's plenty of lenders out there. Find one that will let you take the max LTV that you need. Make sure with your numbers that the loan amount with this new LTV is not going to make you cash flow negative. So you still at least want this property to float itself, right? You don't want to come out of pocket every month to pay the debt service. Let me just use easy numbers for easy calculation. So you bought the property for 500,000. Now you've done some value add strategy and the property's worth 900,000. And so you refi, you have a 75% LTV, which means you have 25% of your equity still stuck in the building, but that's equity that's still part of your overall net worth. If you get an LTV for 75%, then you have $675,000 as a new loan. If you pay off the underlying 500,000, which is probably a little bit less because you had some principal pay down during your whole period. But if you do that, now that's $175,000 that you have to use as a down payment on the next property, right? So this is a powerful strategy. It's not to say that you are going to double the value in the time period that you're doing your value add strategy, but there is a lot of equity. There could be a few $100,000 at least realized on a value add play. So now you've bought your next building and you find another value add strategy and you implement this process over again. And you could plan to buy 5 properties, just rinse and repeating this value add, refinance, and repurchase another investment property strategy. And that can build up your wealth. So now you have 5 buildings, let's say they're all worth $1 million or more, and that's adding to your net worth as your tenants are paying down the principal on these properties. Now, here is the caveat that I mentioned earlier. A lot of people don't realize that with a value add strategy, this is extremely intentional, that you are working to put in extra capital, put in rehab financing, even if that rehab financing you get from the lender, that's fine. But normally, because it's a value add, at the very beginning, the value is not really there. But if you think about it, at the very beginning, normally, if you have to increase rents, that means rents are low. If you have to decrease expenses, it means expenses are high, so it's taking away from the cash flow. All of that is taking away from the cash flow, right? If rents haven't been increased, if it needs to be rehab, the person who's renting it is not paying the same as someone paying top dollar for a newly renovated unit, right? So you have to go in and increase the rents. You have to go in and fix the units so that you can get higher rents. You have to go in and find new vendors to decrease the expenses. So during that time at the very beginning, the cash flow is not going to be there. It might have enough cash flow. You should buy cash flow that has enough at least for the building to float itself. But as you're implementing this value add strategy, you might even need to put more capital into the building for any unit upgrades or things like that. And now you can get that financed from the lender. So search around for lenders who will also finance the construction or rehab costs because they do exist. But in the very beginning, cash flow is low because you haven't implemented your value add strategy yet. So if you are delaying good cash flow for the potential appreciation that you're going to get, and I don't even say potential because this is something that you can map out and plan, right? But you're going to need other sources of cash flow while you're implementing this strategy. So you either need your W-2 job, you need other investments that are giving you cash flow, you need a good side hustle, anything like that to help float you so you're not stressed out with no money while you're implementing a rehab or whatever the value add on this property is going to be. So you may be delaying cash flow for building up this appreciation and increasing the value of your building, but that's not a bad strategy, because if you really want to build true wealth, cash flow won't do it for you. You really need value. So being able to not think about your immediate needs and think about the long-term game of building wealth and what that's going to do. It might be a sacrifice now, might be a lot to work your W-2, have these other investments, or do a side hustle while you're implementing value add on this building. It might be a struggle. You might have to sacrifice some things, but it's going to pay off, right? You need more than just cash flow if you want to build wealth. And yes, you can also buy and just wait for market appreciation or inflation to increase the value of your property, especially if you do market research and you pick a market that's known to be a highly appreciating market. Those markets are also normally lower on the cash flow side, but they do appreciate. So you could do that. Buy in a market that is going to appreciate, or buy in a market that is up and coming. So you could buy lower and watch your value increase. Waiting for the market is fine, but I consider that more of a cherry on top. So it's kind of like you build up your whole Sunday and the market happens to appreciate on top of the strategy that you're already doing. That just like boosts you over the goal even a little bit further, right? So imagine if you did a value add in a highly appreciating market, or a value add in an up and coming market. So you're already getting the appreciation push from your play, your value add play, but now the market is also increasing on top of that. That's just like, oh, you got extra money now. Hey. So anyway, I'm actually working with one of my mentees on this right now, this exact subject. This is about being crystal clear on your goals so that you can be crystal clear on the strategy that you need to use in order to implement the goals that you have planned out. So just keep this in mind. Where are you trying to get to? And what are your strengths, weaknesses, and resources? Because figuring that out and being very clear about what those are, that will determine on how you plan to get there and what the strategy is behind your plan. And then you won't be easily swayed one way or the other when you see opportunities that may be good opportunities, but they don't fit the roadmap that you've laid out for yourself. So in any case, I hope this was helpful. Please keep building wealth.